I understand you correctly, those short-term trades and shorts in general has been an active part of the fund. Maybe that's not as typical because maybe shipping investors tend to buy an equity hoping it will go up.
Yeah, correct. Shipping is cyclical. It's capital intensive, and I would say the most successful listed companies we have seen over the past 20 years have been those who have distributed capital when they have made money, and when they come into the cyclical trough and are losing money, they ask maybe the same shareholders, we need to be capitalized again because we are on the brink of bankruptcy. But we want to employ that capital buying more vessels because now they're cheap. On the other side, we see companies hoarding cash at the peak of the cycle, not giving cash out to the investors. And because the argument for some of them at least is they want to retain that cash to invest when things are looking good again. But we as investors, we want that cash out now. We want the cash to employ in other segments which have higher expected return. Anyways, it's important to be able to short these equities, I would argue. You can employ a long owner strategy, but then you have to have cash positions during the cyclical contraction. It makes much more sense to be short. So at present we have 9% net short in our fund because we believe the cyclicality of most shipping segments are at peak or have peaked, but we are a long short fund. So we can make money in any market. That's the way I believe you need to be set up in shipping to really make a decent return across cycles.
Just finishing, the universe you invest in, we have sort of heard about the equities and the shipping segments, but debt, forward contracts, offshore market, offshore vessels, what is on your radar? And is that also a constant debate? Should we add the universe slightly to go more offshore, or we're going to keep this shipping and then look at debt or forward contracts in addition, but mainly the equities, short and long?
So we have a very wide and pragmatic mandate, but we are focusing on shipping purely. And for us, that means not cruise shipping and not offshore shipping. We are focused on, we prefer commodity shipping like oil, petroleum products and dry bulk products and gas and so on. But we can also do more industrial shipping. There's nothing wrong with shorting Williamson, for instance, for us. But in terms of investment instruments, so our approach is basically we look at the fundamentals. We identify which is going to kind of contract and which is going to expand, and then we employ capital given the upside or downside and the risk to each of those segments, and we get a balanced portfolio plan, and then we look at what investments or assets we wanted to employ our capital in. And since October, maybe, NAV in shipping companies has been quite low. So it's been attractive for us to employ capital in equities. In January, we saw the opportunity to employ capital in the forward freight agreements in dry bulk because they were quite low. So we made it's much more elastic. So we made 60% on that FFA trade alone over a month. It's very elastic. So we don't take that big position that we would otherwise in equities. And when you have a kind of a cyclical contraction and trough, we will be looking at kind of bonds and mezzanine because that's when, in our opinion, you want to be investing in those type of instruments, depending on pricing. Then we would potentially look to pay 50 cents on the dollar for a shipping bond if the market thinks they might be bankrupt or not able to repay the loan. But our models suggest that they will be able to, or we can get an attractive conversion into equity.
Perfect summary. So let's dive into markets. Let's start with some overrated shipping segments the next 6 months, to use that as a base case. What is overrated right now in shipping?
So I briefly mentioned our short in Williamson. We are short car carriers broadly, and we are short containers. And given now the recent price appreciation in both segments, we have increased our shorts. For us, it makes a lot of sense. It makes sense from a portfolio management perspective. We are de-risking our Red Sea reopening. We are de-risking kind of the tariffs and the negative sentiment from global trade and negative trade growth potentially. And also we are fundamentally short these two segments. Both segments have had or are in the midst of big fleet growth. We see limited demand growth in both segments. And again, valuation now coming up since early April. And then we shorted them down from some of them from 130 down to 60, and then now they come up again to 80, 90, and then it's natural to add on shorts at those levels. And also containers, we are shorting broadly. We have a big short position, and it's very challenging to see the upside risk in equities, but it's very easy to see the downside risk. So for us, it's a very attractive risk reward.
What will be the net effect of a full opening of Red Sea, for instance? Because that's been a huge driver.
Yeah, it's huge. For containers, I think it's 10 to 12% demand growth demand that is removed from the market. We did see last week CMI, CGM talking about reopening their Mediterranean Express through the Suez. We also heard chatter about Evergreen and Yang Min doing some similar moves. It's at this stage, it's the number of transits at face value is very low, but the theoretical effect of someone starting to go through the Suez Canal is huge, because as soon as someone goes through the canal, it's like a prisoner's dilemma. If they make super profits, everyone has to do the same, and then no one is earning super profits anymore. Everyone's just earning less. So it's a perfect kind of short equity fundamentals. And then Egypt is having implemented that 15% discount on the larger container vessels. There's a lot of incentives, and for the segments that is most affected is containers, it's car carriers, and it's product tankers. And last week, when oil tankers had a very good week, and they have been moving up a lot since early April, we took the opportunity to divest some of our mainly focus on product tanker longs, because it also fits into what we think is very interesting news last week, which I think the market really didn't price in. We'll see. Maybe it's not that significant as we think, but we will see. But we wanted to take some chips off the table, or the Red Sea table, and it made sense for us then to also divest some product tanker and take some gains as we head into what is usually a very seasonal, sluggish period for oil tankers.
I was trying to look for some, bright lights in the car carrier story, and I don't know, if China takes all the EV market, they weigh more. Do you need to stack them differently in case of fires on board ships? I don't know if that's gonna make any difference. I don't know.
I think that's on the margin, if anything. I think you should look at how many new buildings are coming on the water, and be fearful of opening of the Red Sea.